For decades, silver has occupied an uncomfortable place in global markets, too industrial to be treated like gold, too monetary to be treated like copper, and that ambiguity is exactly where the real risk begins to form. At first glance, the idea of selling silver at $100 an ounce feels rational, even disciplined. A round number invites closure, profit-taking, and relief, yet markets rarely reward decisions that feel emotionally complete. And this is where the surface logic starts to fracture. Historically, price targets that become widely discussed tend to function less like exits and more like pressure points. They attract positioning, hedging, and structural responses that alter the very conditions that made the target seem reasonable in the first place. And silver has a long history of behaving differently once attention converges. Behind closed doors, silver isn't discussed as a simple trade. It's treated as a stress variable, a material that exposes fragilities across supply chains, energy systems, and financial plumbing, and when its price moves decisively, institutions don't react linearly. What rarely gets acknowledged is that silver's price doesn't rise in isolation. It rises alongside shifts in confidence, liquidity, and trust in abstraction-based assets, and when those forces align, valuation metrics that once seemed conservative stop functioning altogether. At the retail level, $100 feels like a finish line. At the institutional level, it can register as a signal that something upstream has already broken, and selling into that moment may mean handing inventory to buyers who are no longer price sensitive. The common assumption is that triple-digit silver represents excess, speculation, and eventual mean reversion. Yet previous episodes suggest that the most violent repricing phases tend to begin after the crowd believes the move is already complete. What complicates this further is silver's dual identity. Industrial demand doesn't pause simply because price rises, and monetary demand doesn't retreat just because profits exist, creating a compression effect that can persist longer than expected. In that environment, selling becomes less about capturing gains and more about timing structural transitions that aren't visible on price charts. Miss that transition, and the cost isn't measured in dollars forgone, but in exposure surrendered. The uncomfortable question, then, isn't whether silver can reach $100. It's what conditions would have to exist for it to stay there long enough for selling to feel safe, and those conditions may not resemble stability at all. Even more quietly, there's the issue of who is buying at that level. When demand shifts from opportunistic to defensive, the psychology of the market changes, and exits that once felt obvious start to disappear. That's where the real asymmetry begins to emerge. If silver reaches a price that forces institutions to reclassify it, the act of selling may no longer be a neutral decision, but a strategic mistake made at exactly the wrong moment. And that raises a deeper concern most investors never articulate: whether $100 is a ceiling created by imagination or a threshold created by necessity, because the difference between the two determines who controls the next move. Historically, silver doesn't announce regime changes with volatility alone. It does so through subtle distortions in behavior, long before price confirms what's happening beneath the surface. One of the first signs tends to appear in how liquidity behaves. Spreads widen unevenly, futures volumes detach from physical availability, and pricing starts to reflect urgency rather than equilibrium, even while headlines remain calm and confident. At that point, the market isn't discovering value anymore. It's rationing supply. That distinction matters because rationing dynamics don't respect conventional valuation anchors, and silver has been pulled into that role more than once. What often gets overlooked is how thin the silver market actually is. Compared to major asset classes, it takes remarkably little sustained pressure to overwhelm supply mechanisms, and when that happens, price becomes a secondary signal rather than the driver. Available data suggests that above certain levels, industrial buyers don't exit the market, they reconfigure. Contracts get restructured, stockpiles are rebuilt quietly, and procurement shifts from cost optimization to continuity protection. That shift creates a floor that doesn't behave like traditional support. It doesn't invite selling. It absorbs it, gradually removing material from circulation while price remains deceptively stable. Meanwhile, financial participants tend to misread that stability as exhaustion. Selling increases just as physical tightness deepens, transferring exposure from weak hands to entities with longer time horizons and fewer liquidity constraints. This is where the $100 assumption becomes dangerous. It presumes symmetry, that buyers and sellers are reacting to the same signals, when in reality they're responding to entirely different risks. For some, a higher price represents opportunity. For others, it represents operational threat. Those groups don't negotiate the same way, and silver sits at the intersection of that conflict. There's also the question of substitution. In theory, higher prices invite alternatives. In practice, many silver-dependent applications lack viable replacements at scale, especially where performance tolerances are narrow. As substitution fails to materialize, demand stops being elastic. Once that happens, price loses its power to self-correct, and targets that once felt ambitious start to look procedural. What follows isn't a spike, it's a grind, the kind that convinces sellers they've made the right decision, right up until inventory disappears and re-entry becomes structurally expensive. The market rarely signals that moment clearly. It arrives disguised as normalization, a pause that feels like relief, while the underlying imbalance continues to compound quietly. By the time that imbalance becomes visible, the exit window that existed at a clean, emotionally satisfying number may already be gone, replaced by something far less forgiving. And that's when the question shifts from whether selling at 100 was prudent to whether it was premature, because the market may not be asking for silver anymore, it may be demanding it. At the institutional level, silver's role is rarely discussed in isolation. It's evaluated alongside energy inputs, strategic materials, and financial hedges that only matter when systems are under strain. When those evaluations change, they don't result in public announcements. They result in altered behavior, quieter accumulation, longer dated contracts, and a noticeable reluctance to part with physical inventory regardless of price. That reluctance tends to surface first in leasing markets. Availability tightens, terms become less flexible, and participants who relied on short-term access begin to face friction they didn't anticipate. From the outside, this looks like a technical anomaly. From the inside, it's treated as an early warning, because leasing stress often precedes more visible dislocations. As silver moves through psychologically significant levels, institutional risk models start to shift focus. The question stops being how high price might go and becomes how disruptive absence would be. In those models, price is a poor proxy for risk. A high price can be tolerated, a missing input cannot. That distinction changes purchasing behavior in ways that don't show up immediately on charts. Reports indicate that when this transition occurs, buyers stop waiting for pullbacks. They secure exposure opportunistically, sometimes at levels that appear unjustifiable to observers focused on historical ranges. This behavior creates a feedback loop that sellers rarely anticipate. Each round of profit-taking reduces available float, increasing the intensity of future price responses even if demand remains constant. The result is a market that appears volatile without being speculative. Moves feel sharp not because enthusiasm is high, but because elasticity has collapsed. At that stage, traditional signals become unreliable. Momentum indicators lag. Volume metrics distort. Even volatility loses its predictive value, offering comfort where caution would be more appropriate. For investors watching from the sidelines, a $100 print looks like vindication. For those embedded in supply networks, it looks like confirmation that previous assumptions are no longer safe. That divergence in interpretation is where costly decisions tend to form. Selling based on visible confirmation, rather than invisible constraint, shifts exposure at exactly the wrong time. What complicates this further is timing. These transitions don't unfold over days. They unfold over quarters, slowly enough to feel manageable, fast enough to prevent clean re-entry. By the time broader narratives adjust, the market structure has already changed. Liquidity thins, pricing gaps widen, and the cost of hesitation becomes measurable. In that context, selling silver at a symbolic level isn't just a trade, it's a bet that the system consuming it remains stable, adaptable, and predictable, and that bet may be more aggressive than it appears. Behind closed doors, the conversation around silver often drifts toward something less comfortable: correlation breakdowns. When assets that are supposed to move independently begin responding to the same stressors, silver's behavior becomes harder to categorize. In those moments, silver stops acting like a commodity and starts behaving like a signal, not a forecast, but a confirmation that liquidity preferences are shifting in ways models struggle to quantify. That shift tends to coincide with rising sensitivity to counterparty risk. When trust thins, claims matter less than control, and physical assets regain relevance regardless of yield or convenience. Silver sits awkwardly in that transition. It's accessible enough to move quickly, yet embedded deeply enough in infrastructure to resist liquidation, creating tension between financial and operational priorities. As prices approach levels that feel extreme, many assume financial players dominate the market. Yet evidence suggests that the marginal buyer often isn't chasing returns. They're mitigating exposure to disruption. This distinction explains why selling pressure can increase without weakening the trend. Each sale satisfies immediate demand without addressing the underlying need, allowing price to advance without euphoria. At the same time, policy environments begin to matter more, not through direct intervention, but through secondary effects on credit, energy costs, and capital allocation that quietly alter material flows. When those pressures align, silver's pricing starts reflecting systemic insurance rather than speculative appetite. That's a regime where conventional exit strategies lose their edge. What makes this particularly risky is the lag in perception. Retail narratives adjust slowly, anchored to historical peaks and past cycles, while institutional frameworks adapt in real time. Selling into that mismatch can feel rational. Charts still look extended, sentiment appears stretched, but those indicators were designed for markets with elasticity, not constraint. The market doesn't punish that decision immediately. It offers confirmation first. A pullback, a consolidation, a pause that reinforces confidence and invites final exits. Then conditions tighten again, and the same sellers find themselves competing for re-entry with buyers who never intended to leave. At that point, the price isn't the obstacle. Access is. Premiums widen, delivery timelines stretch, and exposure becomes fragmented across instruments that no longer track cleanly. The original $100 decision starts to look less like discipline and more like misalignment with the new structure. What's unsettling is that this transition often completes without drama. No crash, no spike, no moment that forces reconsideration, just a quiet redefinition of what silver represents. And once that redefinition settles, the opportunity cost of having sold at what once seemed like a definitive high becomes impossible to ignore. For decades, silver's volatility has trained participants to expect reversals. Sharp moves up are supposed to be followed by equally sharp corrections, a rhythm that conditions sellers to act early and often. That conditioning becomes a liability when volatility stops signaling excess and starts signaling friction. Price swings begin reflecting distribution stress rather than speculative churn, and the old playbook quietly fails. One of the least discussed factors in this phase is inventory visibility. Above certain thresholds, transparency diminishes. Stock levels become estimates, reporting lags grow. What's known with precision shrinks. As clarity fades, participants with mandates to ensure continuity move first. They don't announce it, they don't chase headlines, they secure supply in increments that don't attract attention. Each of those actions is small in isolation. Together they create a drain that price alone can't explain, and by the time the effect becomes measurable, it's already embedded. This is where selling at a milestone price reveals its hidden risk. It assumes that the market remains legible, that signals remain honest, and that exits remain orderly. But when legibility breaks down, markets don't reverse cleanly. They gap, they fragment, and they reprice in ways that feel disconnected from fundamentals as they were once understood. There's also a temporal mismatch that rarely gets acknowledged. Financial markets react in minutes. Industrial systems react over months. When silver bridges those timelines, price discovery becomes distorted. Selling into that distortion can feel prudent. Momentum looks tired. Volume looks erratic. Yet those are symptoms of transition, not exhaustion. As that transition deepens, silver's optionality changes. It's no longer just a position to be closed. It's a lever that interacts with multiple risk domains simultaneously. At that point, even sophisticated participants struggle to model outcomes. Scenarios widen, probabilities flatten. Decisions rely less on forecasts and more on tolerance for uncertainty. That's when symbolic numbers lose their authority. $100 becomes just another print in a sequence that no longer respects psychological anchors. The danger isn't missing the top. It's misunderstanding the nature of the move, treating a structural repricing as a cyclical spike and responding with a cyclical strategy. Once that mistake is made, reversing it isn't straightforward. Re-entry carries different risks than the original exposure, often requiring concessions that weren't necessary before. And that's when the question shifts again, from whether selling was justified to whether holding would have been simpler, because complexity has a cost that isn't always visible up front. At this stage, silver's behavior starts to expose a deeper imbalance, one that has less to do with price and more to do with trust in throughput. When systems rely on uninterrupted flow, any hint of constraint forces defensive behavior. That behavior isn't coordinated, but it rhymes. Procurement cycles shorten, buffer inventories expand, contracts get renegotiated with clauses that prioritize delivery over cost. None of this requires panic to be effective. What's deceptive is how calm the surface can look while this is unfolding. Prices may drift sideways, commentary may grow dismissive, the absence of drama becomes a signal in itself. Sellers often interpret that calm as confirmation they acted wisely. The market didn't run away. The correction they expected seems to be forming. Confidence settles in. But underneath, the character of demand has already changed. Buyers aren't reacting to price anymore. They're reacting to vulnerability, and vulnerability doesn't fade just because charts flatten. This is where silver's small market size becomes critical again. It doesn't take a surge in demand to create imbalance, only persistence, and persistence is easier to underestimate than spikes. As the available float tightens, pricing mechanisms begin to misfire. Futures diverge from spot. Physical premiums decouple. Arbitrage windows close faster than participants can exploit them. From the outside, this looks messy but contained. From the inside, it feels brittle. Any additional stress threatens to propagate through layers that were assumed to be resilient. In that environment, selling at a known number offers psychological relief, but little strategic advantage. Exposure is gone, but optionality has gone with it. Rebuilding that optionality later often requires compromises, longer settlement times, higher counterparty risk, instruments that track imperfectly under stress. The irony is that none of this requires silver to soar immediately. The cost of selling shows up gradually, through missed flexibility rather than missed profit. What once felt like a clean exit begins to feel like an irreversible decision, not because the price kept rising, but because the conditions that made ownership simple no longer exist. And that realization tends to arrive quietly, usually when the next external shock hits and silver responds in ways that no longer align with familiar patterns. That's when the $100 decision stops being about valuation and starts being about positioning, because the market has already moved on, even if the price hasn't. What makes this phase particularly uncomfortable is that it doesn't reward conviction. It rewards alignment. Those positioned in line with the new structure experience fewer surprises, while those who exited early find themselves constantly reassessing. Silver's historical tendency to mean revert becomes less useful as a guide. The reference points that once anchored expectations lose relevance when the underlying drivers no longer resemble past cycles. This is where narratives begin to fracture. Some argue the move was excessive and temporary. Others stop commenting altogether, not because they lack an opinion, but because their framework no longer fits. In that silence, positioning speaks louder than commentary. Holdings consolidate. Turnover declines. The market grows less expressive, even as its implications widen. Selling at a widely recognized level during this phase doesn't provoke immediate regret. It provokes a series of small frictions, each easy to dismiss on its own. Access becomes slightly harder. Pricing becomes slightly less transparent. Substitutes become slightly less convincing. Over time, those slight changes compound. What's often missed is that silver doesn't need to become scarce everywhere to matter. It only needs to be scarce where it can't be replaced easily, and those pockets tend to be hidden. As those constraints deepen, silver's role as a balancing asset becomes more pronounced. It offsets risks that aren't easily hedged elsewhere, making its absence more noticeable. That's when former sellers start watching price not with anticipation, but with unease. Not hoping for a drop, but fearing a recalibration that leaves no clean entry. The market doesn't offer closure here. There's no clear signal that says the window is shut. There's just a gradual realization that decisions now carry asymmetrical consequences. Re-entering feels optional until it doesn't. Waiting feels prudent until it feels expensive. The transition between those states is rarely obvious in real time, and that's the trap of symbolic exits. They promise certainty in a market that's quietly abandoning it, leaving those who sought clarity navigating a landscape that no longer responds to familiar cues. At that point, the cost of selling at $100 isn't measured against a higher price. It's measured against the loss of adaptability in a system that's growing less forgiving. By the time this final phase takes shape, silver no longer trades primarily on expectation. It trades on necessity, and necessity doesn't negotiate the way sentiment does. The market's language shifts. Instead of forecasts, participants talk about coverage. Instead of upside, they talk about exposure. Price becomes a secondary concern, a consequence rather than a target. Those who sold at a clean level often realize too late that they didn't just exit a position. They exited a context, one that allowed them to interpret signals with confidence. What replaces that context is less accommodating. Information arrives fragmented. Signals conflict. Decisions feel reactive rather than deliberate. In this environment, silver doesn't need to rise dramatically to impose costs. Stability at elevated levels can be more disruptive than volatility, because it confirms the new normal without offering relief. Holding silver through that transition isn't about conviction, it's about continuity, the ability to respond without renegotiating access under pressure. The mistake many make is assuming that risk increases linearly with price. In reality, risk often migrates, moving from valuation to availability without warning. When that migration completes, the $100 question loses relevance. The market stops asking whether silver is expensive and starts asking who still has it. That's the point where selling earlier feels irreversible, not because of missed gains, but because the landscape has shifted beyond familiar boundaries. Silver doesn't announce that shift. It reveals it gradually through behavior that only makes sense in hindsight. And once hindsight arrives, the decision to sell at what once felt like a disciplined high can't be revisited, only reinterpreted, under conditions that are far less forgiving. For decades, markets have taught participants to believe that discipline means exiting at strength, locking in gains, and moving on. In most assets, that lesson holds. In silver, it has always been incomplete. Selling at $100 feels decisive because it offers emotional closure. It transforms uncertainty into a number, a finish line that seems rational and defensible. But silver doesn't respect finish lines. It respects function. When price rises because sentiment is stretched, selling is logical. When price rises because systems are adjusting to constraint, selling becomes a different kind of decision, one that trades simplicity now for complexity later. The cost of that trade doesn't arrive as regret. It arrives as friction, as fewer clean options, as a sense that the market is moving but no longer speaking the same language. Silver's real value isn't revealed at peaks. It's revealed in transitions, when liquidity, trust, and material necessity begin to diverge. Those moments don't announce themselves loudly. They pass quietly, disguised as stability. That's why the most expensive mistake with silver isn't selling too late. It's selling at the moment when ownership shifts from being about price appreciation to being about strategic position. By the time that distinction becomes obvious, the market has already repriced something more fundamental than metal. It has repriced access. And once access is what's scarce, the number you sold at stops mattering altogether.